Welcome to episode 2 of The Signal, where we'll be speaking about Solana liquid staking today, how the LST market is currently set up on Solana, how the economics work, and what the main differences really are between LST markets on different chains, mainly Solana and Ethereum. But before we do get into that, I think we could quickly touch on what's just happened in the market over the past week. The fourth Bitcoin halving just happened. That's a pretty big one. And I know that, Michael, you spend quite a bit of time analyzing the Bitcoin ETF flows. So it would be interesting to at least hear the state of those flows as of today.
Absolutely. Great to be back, Oskari. Just a little preface before we jump in here. Slightly under the weather, so hopefully my voice hangs up for this episode. But let's hop right in and share some data here. So just pulled up some data. This is Farside Investors data just on the Bitcoin ETF flows. And, we've been tracking this from the start. The total ETF flows to date is still over 12.3 billion. So definitely has exceeded expectations. But we can see that there's been a number of days of outflows over the last week or so. And if you look at the last 13 days or so, about half of them have been outflow days. So I think the Bitcoin ETF, that initial surge that we saw is starting to wear off just a little bit. And I don't know about you, Oskari, but I've definitely been sensing a lot more bearish takes just on crypto Twitter, on Telegram, just in conversations as well. We know these markets are very sort of volatile and the sentiment swings with the price movements. But yeah, this is where we're at. My view on this is that we're in a little bit of a lull. This is like a sort of, we've had a little bit of a pullback. I think Bitcoin has mostly rebounded, but Bitcoin dominance is really strengthening. So Bitcoin is almost at 54% dominance, which is the highest it's been this cycle. And that's pretty typical. We've kind of been calling for this with the ETF, with Bitcoin's strength, with kind of the early stages of a bull market. And everything I'm seeing is lining up with what we've seen in past bull markets, with the exception that Bitcoin hit its all-time high before the halving in this cycle. So we'll see. We've gone through the halving now. Typically, the price action doesn't kick in for 6 months or so after the halving. But yeah, curious your take on kind of where Bitcoin's at, where the markets are at, what you're seeing just sentiment-wise.
Yeah, the sentiment swings a lot. And to be honest, it's something where I need to check myself quite often that I don't get pulled into the narrative and start overthinking myself, because I'm a long-term investor, fundamental focused investor. And thinking from that perspective, I feel like the fundamentals have never looked better. And even just looking at these inflows here, it just speaks to the fact that, we're in a great place for the long-term growth of the crypto asset ecosystem. And because there's so much talk about the metrics like inflows, and people, especially on Twitter, tend to focus on even like daily inflows and outflows and making kind of assumptions based on that. I wanted to hear from you that when you're looking at these data points, what is it exactly that you are trying to get out of it? So like in layman's terms, what are the actionable insights that you take away from data like this?
I am mostly looking at data and taking in the data and sort of trying to separate myself from the sentiment in the market, right? I think that is the key, is just like to get out of the emotion of the market, look at the data, and then go to crypto Twitter and see what are people saying. And usually like this type of data certainly makes its way, it gets surfaced on crypto Twitter, and that's where the sort of market reaction is coming from. But yeah, I think for me, it's just, I'm a long-term investor, so I'm not a trader. So I don't really get caught up too much in the swings. And like, for me, watching the market starting to get into like a panic mode, because everybody has watched prices go up for, I don't know, like almost 6 months or so, a pretty strong period of price action. And then when that ends, everyone thinks the world is ending. And like, the reality is that these bull markets typically get at least 10 to 12 corrections of at least 15% in a bull market. And I think we just had like our first or second of this bull market. So it's typical. And yeah, just always trying to pair up like what's the truth. And the truth to me is like the data, and then what's happening with market sentiment, and looking for like a dislocation there. So yeah, well, that's kind of the strategy.
Very much aligned on that. And even just from a day-to-day basis in terms of what I do for work, the level of institutional interest we're seeing right now, we haven't yet seen this level of institutional interest at any previous cycle, and the halving just happened, so you could argue that we're pretty early. So this time around, it feels quite easy to not focus on the short-term narratives because everything tends to be playing out pretty well in reality.
Yeah, couldn't agree more. And just one more point on that is I was listening to Matt Hogan from our friends over at Bitwise. And he was talking about how the Bitcoin ETF is sort of like this spigot that has been turned on about 20% or so. And, Bitwise is like the number one crypto asset management firm out there. They're out there doing a roadshow, talking to as many institutions as possible about Bitcoin. And basically what he's saying is that most of these larger institutions don't even have the opportunity to buy ETFs just yet. Yeah. They have to get plugged into all these wirehouses that are out there. That usually takes 6 to 12 months for all this infrastructure to get built out before it's even available to everybody that can buy it. So I think that's pretty interesting information given how much of inflows we've seen just in the first few months or so without it being open to the entire market. So I think there's going to be more to come, and I'm expecting this cycle to be a big one because of this. So my sentiment I haven't changed.
And that is actually a really interesting point. And also, even a lot of the funds investment managers who would technically have the ability to allocate to these ETFs don't have like the compliance or regulatory approval from inside of the company. So there's also that basket as well. And I'd say like a big chunk of, like, for example, the biggest banks in the Nordics have like completely made it almost illegal for any employees to do anything with crypto or even speak about it with clients. And that's still the state of things. Yeah. So there's still a lot to unlock there. But do you have any other market updates that you want to quickly walk through, or should we move on to Solana?
I think that's it. We could probably jump into Solana and liquid staking.
Let's speak liquid staking then. And to do that, we should probably just quickly preface what staking on Solana really is, comparing it to last week we spoke about Ethereum's economics, where Ethereum is just a proof of stake chain purely that requires users to stake a certain amount of ETH to prove their commitment to becoming validators. Whereas Solana is a similar proof of stake model, but it's a delegated proof of stake chain that opens the transaction validation system to the entire network, actually. So it aims to involve everyone, even those who are unable to meet the minimum requirements for becoming validators. Because one issue with Ethereum is that there's the 32 ETH minimum stake amount if you want to run your own validator, right? And then liquid staking came along to allow a lot of people to tap into that yield and delegate to these validators. But with Solana, the whole system is different. There's no like minimum staking requirements in terms of the amount of SOL, but there's actually pretty big hardware requirements. But then the ability to actually delegate your stakes gives everyone the opportunity to come in and help validate the network. So I was wondering, could you walk through how this difference at a high level affects both the traction and economics of liquid staking on these different chains, and especially why you're so interested in liquid staking on Solana specifically?
Yeah, no, that's a great preface for this conversation. I have been very interested in the setup over on Solana for liquid staking, and it primarily comes from looking at how things have played out on Ethereum. And you're right, there is a big difference here. So if you look at the total amount of SOL that's staked currently, it's about 65% of the circulating supply. And on Ethereum, it's closer to 27% or so, maybe closer to a third of the circulating supply. And I think the reason for this is that Ethereum started off as a proof of work network. They transitioned to proof of stake. When they made that move, they set up the beacon chain. People were able to deposit, and these were mostly like OG Ethereum whales that were staking initially into the beacon chain, and they could not withdraw, right? They had to lock up their ETH and essentially just like cross their fingers and hope that the transition to proof of stake worked, which it did. And then with the Chappelle upgrade, which was about a year ago, that was the moment that people could unstake, and basically anybody that wanted to stake could go in and come out. And we saw liquid staking solutions sort of take off on Ethereum at that time. And the stake rate has doubled on Ethereum since that Chappelle upgrade. The difference with Solana is that it was not a proof of work network to begin with. They started as proof of stake. And so you have a lot of these like really large Solana investors, people that are supporting the network. You have large institutions like Coinbases of the world that are running validators on Solana. And so you have a ton of SOL locked up in native stake, right? Not within liquid staking solutions. And only about 6% of that total SOL that is staked is in liquid staking. This is very different from what we see on Ethereum, where almost all of the stake on Ethereum is in liquid staking solutions. So that kind of opens up the question of, is Solana going to end up in this place where Ethereum is at, where that gap between 27% of the SOL staked in liquid staking collapses from the 6%? Are we going to see a big influx of SOL into liquid staking? That was kind of the first item to explore. And if the answer to that is yes, why is there going to be more SOL moved from native stake into liquid staking? The reason that someone might want to do that is so that they can be liquid, right? So if your SOL is locked up in a validator, you do have the ability to withdraw it. This is another key distinction on Solana, that you can withdraw within a day, 2 or 3 days. That was not the case on Ethereum, so that was another difference there. The key insight for me was that if liquid staking is so popular on Ethereum, you would think that's going to translate to Solana, right? People are going to want to be liquid with their SOL staked. They're going to want to have the ability to stake the asset, earn the yield, also move the asset into DeFi, earn extra yield, provide liquidity. And this is really important for just like the capital efficiency of SOL itself. And this is something we've talked about with Ethereum. We've seen more and more Ethereum moved into DeFi, moved into the ecosystem, either as supporting staking or within DeFi, lend and borrow applications, within DEXs. We've seen more and more capital efficiency with ETH over time. And so the thesis is that we would see a similar setup on Solana. And so when I started looking at Solana, it was really just Marinade. That was the only liquid staking solution. There were a few others, but Marinade really controlled the market. And, this was in like the crypto winter of last year. And I wrote about Marinade Finance. And I want to say it was like a $6 million market cap at the time. And they had been around for like a year and a half. And I liked everything that I was seeing with the team. And they were spun out of a Solana hacker house and like had close ties with the Solana Foundation. It just looked like this is a really interesting project. It had no VCs. And I started using the product. I liked the product. I talked with a few of the team members. And so I'm an investor in Marinade. And my thinking on this whole space has been evolving. We've seen Jito come out now. They came out and launched their token just, I think, in Q4. And that was kind of the moment when like everyone realized that liquid staking was a thing within Solana, because Marinade really didn't get a lot of attention. When Jito launched their token, it came out pretty competitive, I think, with where Lido was priced at. And Marinade immediately sort of repriced at that time. So Marinade was like 3 cents, $6 million market cap. It went up to 60 cents, market cap. I can't remember exactly how high the market cap got. It's since come down a little bit, but my thinking continues to evolve here. And maybe I'll pause there just to sort of get your reaction to this. I know you've spoken with the folks over at Lido. I'm curious, like just kind of your thoughts on this setup. And then we can get into the current leaders on Solana. And then I want to talk a little bit about a new protocol that I think is introducing a new business model that may totally change what I was originally forecasting on Solana. So,
yeah, definitely. Thank you for that. I mean, when we think of Ethereum and liquid staking there, like the discussion has been very much around centralization risk, where once Lido came out the gate, introduced liquid staking, pretty much just started dominating the market. And mainly the discussion has been that, okay, how do we limit Lido from taking over market share? Whereas on Solana, like you mentioned, the data showcases that it's just a very small portion of all SOL that is liquid staked to date. So the whole discussion is more around how do we just get liquid staking in general to take off? And you have like key opinion leaders, even, Anatoly also chimed in, everyone else just trying to get people aware of the fact that, hey, you can also liquid stake Solana, and there are benefits to that, even though just general staking as well doesn't have as long lockup periods, etc. So, I mean, it's a very interesting setup that also opens the playing field for, I feel, maybe more even innovative models from Solana's perspective. But just starting to dive into what you prefaced there about how your thesis is changing, I really want to highlight the Marinade piece, because when you wrote that back in early 23, Solana was in a rut. So was Marinade, the protocol. Almost all Solana protocols were really in a proper rut. And you had already become interested at that point in time about what might happen. The net deposits on Marinade were something like 40 million at the time of you writing that piece. And as of today, they're up to 1.5 billion. And by net deposits, I mean the total amount of SOL staked through the protocol. So that's just a massive increase, both driven by general price appreciation in Solana, but also the traction that the protocol has gained and the awareness that has come to liquid staking on Solana. and also great price appreciation on the investment you made as well. So kudos on that. I guess we could call that some great signal that you shared out through to your subscribers. And I'll definitely link that piece into the show notes so anyone can go read more detail. So that was a good one.
Yeah, no, I appreciate it, Oscar. Every once in a while, a blind squirrel finds a nut, I guess they say, right? But yeah, we'll link that report in the show notes. And, I just pulled up a screen here. We can just walk through a little bit like the business model of liquid staking and some of the analysis that I was doing on Marinade when it was a really small little protocol, $6 million market cap, which at the time was interesting because we were in the middle of the crypto winter and there were companies had pitch decks that were raising at $20 million, right? And I was looking at this saying, well, wait a minute, this has been around for a year and a half. They got a good team. They spun out of a hacker house. They just had a really good story, they had a good product, and it just made me go deeper. So it started with the product, started with the team, and I started looking at the business model. Then I started looking at what was happening on Ethereum. And I just thought, if you're going to bet on Solana, and if you have conviction on Solana, then you should have conviction on the core infrastructure around Solana as well. And this liquid staking business model seemed to me like this was going to be around. This was potentially a winner take most market. My thinking on this is evolving a little bit, but basically the business model is it's a race to get as much of the stake as you possibly can. Basically what Marinade or Jito or Lido or any of these protocols are doing is, as you mentioned earlier, they're making it really easy for anybody that has a small amount of assets to stake those assets, provide services. If you delegate your stake to another validator, you are providing services on the network and you're paid consensus rewards and transaction fees for doing so. And what Lido and these other liquid staking protocols are doing is incentivizing people to deposit with them. They have a network of validators sitting underneath the protocol that they dish your stake to. They pay a 5% fee to them, and then they take a 5% fee from the depositor. And that's their business model. And it's a pretty damn good business. It's a very scalable business. As you mentioned, Lido basically controls the market on Ethereum. And the thinking was that we would see a winner take most set up on Solana as well, primarily because liquidity begets liquidity. And once you have I really felt that watching Lido take off on Ethereum, it really happened after Aave created a pool with staked ETH. So now all of a sudden there was liquidity for staked ETH within DeFi. And so more and more people wanted to stake with Lido, take their staked ETH, put it into Aave, earn additional fees, provide liquidity. And then it started to go to Uniswap and it started to proliferate around DeFi. And so all of a sudden you have a network effect around that one token. And that was kind of my thinking with Marinade. We can just walk through this real quick. So I had originally, this was like the bear case back in May of 2023. It was about a year ago. At the time, Marinade had annualized DAO revenue about 571,000. My base case was that could go to about 3.1 million. It's currently at about 7.2 million. This has a little bit of variance to it because Marinade actually has two different stake accounts. There's liquid staking and then there's also native stake, which the business model is slightly different. So there is a little bit of variance on this. But basically this analysis looks at the price of SOL as one of the key drivers of this, and then total amount of SOL getting staked, and then the percentage of that the DAO ends up capturing. It's a pretty simple analysis. And we're kind of overshot my base case earlier this year. Now we're below it. We're currently about 657% off of it. But my thinking is that in a year from now, if this trend continues, that Marinade should be able to get to $1 billion valuation. That was my base case, that the token could go to $3.16. Not financial advice. These are scenario analysis based on assumptions and forward-looking data. So certainly not financial advice, but this is my current kind of projection. I'll pause there to get any of your takes, but we can talk a little bit about Marinade versus Jito next, if that makes sense.
Yeah, that could be a good place to continue from here. Because in terms of business model, like liquid staking providers, it's pretty simple. Platform businesses that basically at a high level connect stakers with proof of stake blockchains themselves and take a fee for facilitating that service. Yep. What is interesting and what I believe to be the reason what caught your eye in Marinade is that difference between how a liquid staking protocol on Solana was valued compared to a liquid staking protocol on Ethereum, which is Lido. Because if you look at the price of sales or price to fees multiples for something like Lido, they were very high compared to Marinade. And then what also kind of fortified that point was the launch of Jito, then on Solana, which as soon as the token started trading, the valuation multiples were very much more closely aligned with those that you saw on Lido on Ethereum. So there was a pretty big gap between Marinade and Jito then on Solana, which were maybe a bit more comparable. Now, what's interesting there and what I want to hear your thoughts on is that what do you see as the driver for this? Is it some fundamental difference in their business model, or is there something else?
It's a great question. We're always trying to figure out, are the crypto markets based on fundamentals? Are they based on narratives? Are they based on something else? It's always tricky to say. I think from my perspective, and we can kind of run through some of these comp numbers here. From my perspective, this is just mostly narrative based. And I think that'll become clear as we go through this. But just comparing Marinade to Jito, these are the top two liquid staking protocols on Solana, and they control over 80% of the market combined. And right now, Marinade has about 10.39 million SOL staked, so just slightly more than Jito, which has been catching up and probably is going to pass Marinade, it looks like. So they're pretty even in terms of the total value locked. Number of stakers, Marinade has 118,000, Jito has 91,000. Number of validators that are sitting underneath the protocol, there's 348 on Marinade, 160 on Jito. In terms of the total stake rewards that have been dished out, Marinade has a lot more, 479,000 SOL versus 310,000 SOL for Jito. And that's really because Marinade's been around longer. So that's a lot of the quantitative comparisons. But I think what's actually happening here is there's this narrative that because Jito returns MEV, that Jito is this new thing, and it's kind of like the equivalent to Lido plus Flashbots. And this was a narrative that was out there when they were getting ready to launch the token. The team running Jito is known to be gigabrains in the space. And so I think there's just a lot of kind of hype around Jito. But what's interesting to me is the reason Jito is able to pass back some of these MEV rewards is because of the validator that they've created. So Jito introduced a new validator on Solana that has this ability to pass back the MEV rewards. So we mentioned Marinade has 348 validators. Some of these are Jito validators sitting under Marinade. So Marinade can also pass back MEV. This is something, and that they currently do this. They're currently working on building a dashboard, I believe, to showcase this data. But that to me is the only difference between the two protocols. And it's something that Marinade can do as well because they use Jito validators. From a qualitative perspective, I think this is really where this comparison gets interesting because Jito has some well-known venture capital firms behind it. And we know that well-known VCs have a voice in the market on crypto Twitter and can have an ability to steer narrative. So it's possible that's driving some of this. As I mentioned, Marinade came out of a Solana hacker house. It doesn't have venture capitalists behind the protocol. They basically bootstrapped it. So that's one major difference here. In terms of other qualitative differences, the smart contract itself, Solana Labs developed it for Jito, and it's custom code on Marinade. The validator selection is based on scoring and community votes on Marinade, a little bit more centralized on the Jito side. Marinade has something called native stake. This is a little bit different from liquid staking. This is just giving you the ability to stake with them and bypass the smart contract. So they take no fee on that, but it's just an easier way for institutions to access staking without interacting with smart contracts. And then they also give you the ability to do directed stake. So if you have a favorite validator, they give you the option to stake directly with your favorite validator. So those are the main differences. I mean, I don't see anything that's really jumping off the page at me of why Jito would be priced at $448 million versus a $55 million market cap for Marinade. And it gets even more egregious when you look at the fully diluted market caps, 3.7 billion, which I think is more than Lido for Jito right now, versus 211 million for Marinade. So I'll pause there. What are your thoughts? Just looking at that, that seems like a total dislocation, right?
Definitely fascinating data points indeed. I always try to avoid taking direct stances on how things are valued or making predictions into how they could be in the future. But I'd say my takeaways from this chart are also related to like the distinctions between Ethereum and Solana, in the sense that, like you mentioned, Lido and Flashbots are two very separate protocols on Ethereum. But just on Solana, you take something like liquid staking and MEV, you can kind of tangle those up and build a very lucrative service for users that enables them to earn even additional yield on top of liquid staking itself, thanks to the MEV. And if what you said also is true in terms of Marinade getting into the MEV space, then there isn't too many differences in terms of their business models. So the delta there is definitely very interesting and something worth tracking.
Yeah. So this was a lot of like the thinking behind my thesis. I was originally thinking, okay, one of these is going to be the winner. It looks like they're pretty even right now. What's so special about Jito? Like the market should reprice. If the market's efficient, that it should reprice Marinade. And that kind of happened already. And now Marinade's traded down again. So we'll see how this continues to play out.
Yeah.
I think a few other interesting notes here. So if you look at Lido and you look at Lido's market cap compared to its TVL, it's like 6% on Lido. I'm using this as sort of our benchmark. So 1.8 billion market cap, 29 billion of TVL. And then if you look at Rocket Pool, the number 2 liquid staking token on Ethereum, $471 million market cap, 3.8 billion in TVL. So the market cap to TVL is 12% there. When you look at Jito, it's 32%. So it looks like it's like at least 5 times overvalued when you compare it to Lido. And then when you look at Marinade, sitting at about 4% when you look at the market cap to TVL. So, I mean, it just looks underpriced no matter how you look at it, but it doesn't mean the market's going to correct at some point. That was kind of the thinking behind Marinade. I'm still bullish on Marinade. I'm still a user of Marinade, but I ended up down in New York City and went to a dinner and had the opportunity to meet one of the co-founders of Sanctum, which is a new protocol, or they've been around for a while. I think they were the number 2 staking pool on Solana, and they sort of pivoted to a new strategy. And it's pretty interesting what they're building. Their belief is that liquid staking is going to be a massive market and that it's a huge centralization concern. And so what they're trying to do is make it really easy for anybody to spin up a liquid staking token. And they've created a protocol to make it really easy to do this. And then they're allowing people to trade between all types of different liquid staking tokens. So it's kind of, in some ways, it looks like it's kind of like a curve, the way that curve creates liquidity for stablecoin pairs. It looks like that type of setup on Solana, but for liquid staking tokens. And I think the thinking here is that I'm going to read their narrative, actually. And it's basically that they think Ethereum is sort of doomed here. That's a separate discussion. And the reason they think so is because of the centralization concerns around Lido. And basically what they're saying is we don't want this to happen on Solana. And so what they're trying to do is fight against the centralization by building a unified liquidity layer for staked SOL, basically allowing anyone to spin up a liquid staking token, trade that token. And in doing so, you have the same functionality for all these liquid staking tokens, but you don't have this like moneyness problem and like this network effect issue that is playing out on Ethereum. At least that's their thinking. I don't have conviction one way or another on this, if this is like potentially going to disrupt the market. But, I was looking at some of their metrics and they're doing pretty well. Like, what are your initial thoughts of that, Oskari? Like basically a curve for liquid staking tokens. Does it make sense to you to have 1 million liquid staking tokens? I always thought it made more sense to have like 1 or 2 similar to stablecoins. I'm curious your thoughts there.
I think that's the interesting question that needs to be explored. I haven't thought of it beforehand, but sounds weird because having spoken with the Lido team, etc., one of the big ideas is to create like a liquidity layer in one way on top of ETH DeFi, and kind of fragmenting that layer sounds like an interesting approach and something that would be very hard to do with a bunch of different tokens. So I think what you laid out is Sanctum's idea in terms of unifying that liquidity layer. So basically making it so that it doesn't really matter which LST you are using because they all tap into the same source of liquidity. is a very interesting approach that could solve the downsides that come with fragmentation. But then how that plays out in practice, I don't know. And the question also is, from a business point of view, what do, say, protocols and launchers of LSTs benefit from launching their own LST? Is the incentive there for that to happen? Is Sanctum tapping into something that actually has clear market demand, or is it just a nice idea on paper?
Right. I think that's the big question. Like I said, it does seem like a ton of work. So basically you have to create a protocol that makes it super easy for anyone to spin up an LST. You have to incentivize the DeFi protocols to do this. So I think they've actually gotten Drift, which is a derivatives trading platform, and MarginFi, which is a lend borrow money market, to do this. So they have gotten a few DeFi protocols to create liquid staking tokens. Like every DeFi protocol on Ethereum started to create a stablecoin. Like over the last couple of years, it sort of looks like that could start to play out here. And then they basically have the protocol to do so. And then they own where that's traded. So then they're basically capturing all the fees on the trading. So they think it's going to be a huge market. There's going to be tons of trading, sort of similar to Curve, and they're going to provide the liquidity so that no matter how many liquid staking tokens there are, they all have ample liquidity. And I think what happens here is you deposit. So if you're staking at Marinade, you get your MSOL derivative token, and then you would deposit that into Sanctum's liquidity pools, and you get this other token in return called INF. And then that token represents a portion of all the staked capital within those pools. And you receive your pro rata share of all the staking rewards coming from that pool. And then you also receive a percentage of the trading fees, right? So then the Sanctum's taking some of those trading fees, but they're actually giving some of them to the depositors as well. And so you could kind of see how users might want that extra. You're getting the extra yield if you take your liquid staking token, deposit it over there, and then you get the staking rewards plus trading fees coming off of there. But I need to do more work on that. Maybe we can have one of the co-founders on the show to talk about this and kind of go through his thesis, because he's very convicted on this. And I thought it was very interesting. I've been trying to learn a little bit more about what they're doing. It's a project that I was unaware of until I'd met him and started looking at it. It sort of changed my thinking of how this space could play out. So that was kind of the big takeaway.
Yeah. Some first thoughts that come to mind there. I think it was a few months back we had a discussion about the native yield on layer 2s, like Manta Pacific and such, on Ethereum. Is this like analogously somewhat similar to how you'd think of native yield on an L2, but being able to generate native yield through an LST at a protocol level on Solana? Is that a fair way of thinking of it?
Could be. As you're saying, generating native yield on an L2 in the same way that you're taking in deposits, like taking in ETH deposits, and then giving the yield back to the depositors for an L2, sort of like what Manta
exactly. So what comes to mind with this whole model is the idea to incentivize someone like Drift and MarginFi to be able to provide additional yield to depositors on their protocol through them having their own LST. So is that in somewhat similar, or am I thinking of it in the wrong way?
I think so. I think that's fair. And then, that's kind of interesting, because then you create the incentive for those protocols to like opt into this. And then you need the incentive for the depositors to the liquid staking tokens that are in the market. Now they bring their, MSOL or DSOL or whatever tokens they have. You can see how it could sort of capture a little bit of a liquidity flywheel. And I think they've got some liquidity. Their charts are looking good. We'll see. I think it's kind of interesting. And this is a narratives-based market. So we'll see if this is a narrative that starts to take hold.
And to kind of maybe start pulling this together to wrap up, how, with the information that you currently have on a protocol like Sanctum, how would the introduction of that, assuming that it would gain traction, affect your thesis on liquid staking in general?
It's a great question, because the way this is set up now is like I'm a depositor into Marinade. And so I have MSOL. I could take my MSOL and deposit that into Sanctum's liquidity pools and receive INF token in return. And that's essentially just going to give me extra yield on my MSOL. Nothing has changed for Marinade Finance on that side. The MSOL is still out there circulating. They're taking their fee for providing the service for the initial deposit there. So it's hard to project where's the moneyness. Like basically, the question for me is like, how does the moneyness play out? Because very clear what's happening on these liquid staking protocols on Ethereum have increased the moneyness of ETH itself, right? And now you have restaking protocols where people can get extra yield if you hold. The key thing is you have to hold ETH. With Solana, it appears that the same thing is playing out here. It all comes back to SOL at the end of the day. You have to stake your SOL somewhere, receive a derivative of it, place it into these Sanctum pools. Of course, I think they're making it easy for people to spin up their own liquid staking tokens as well. But at the end of the day, it looks to me like if everyone starts doing this, doesn't INF become the money? Because like if everyone's depositing into these staking pools and you have just a big mishmash of different LST tokens in there, but everyone's pulling out INF, then isn't INF becoming the money thing? Isn't that becoming the central? I don't know if that's becoming a centralization concern, if that's the right way to think about it. But at the end of the day, that's how like Sanctum wins, I believe, is like everyone's holding INF at the end of the day. But I like I said, I need to go deeper on this. We should have one of the co-founders on to talk through this so that we can really understand it. But yeah, I think those are the right questions to be asking at this stage.
And in the long run, what is moneyness really? I don't know if you've heard of the DeFi matrix, something that Balaji coined a while back, and to kind of paraphrase him, I think he spoke about the DeFi matrix as it being to the 2020s what the social graph was to the 2010s, where once we have all assets being able to be held in digital wallets, not just crypto, all real world assets, etc., it becomes the global decentralized exchange of everything against everything, right? And then the concept of moneyness becomes something completely new, where the value of just cash and what we've typically been using as units of exchange gets fully diluted. Because if we live in a world where everything is exchangeable on, Uniswap or Jupiter or wherever, because everything is tokenized, then what is even the need to have something that has moneyness? Then basically, you just trade everything against everything.
Yeah, you get in the grocery line and you scan your phone and you pay with a little bit of Marinade Finance token or whatever. Yeah, I mean, that's a rabbit hole that we probably should go down on a future episode. But yeah, I think that's a fair question because money is all about network effects. And if you kind of reduce those network effects to like anybody can spin up a token, that's pretty interesting. And especially if it's all kind of interoperable and, people take payments in different forms and it gets converted to something else. Yeah, I think it's a fascinating philosophical discussion. I always try to think of like the network effect of the dollar. Like, why did this happen? Like, why do you have these massive euro dollar markets where there's actually more dollars circulating outside the US than there is within the US? And it's very fascinating how this has played out. I think there's a lot of like geopolitical implications that have made it such that, just pricing oil in dollars and things like this, that create this like constant demand for dollars. And when I look at ETH and like the moneyness of ETH, I've sort of looked at it in some ways similarly, where you need ETH to do everything within Ethereum. And that's the key thing. That's what it all always boils down to me. Like, why do you need that ETH? I think we'll see if that continues to persist over time. You need ETH to do a transaction, to interact with DeFi, to send a stablecoin payment, to do anything on chain, just like you need dollars to, go about your daily life. And so that creates that network effect. We'll see how it shakes out. But I think SOL and ETH and Bitcoin are the three things that have the most like moneyness to them so far.
I agree. And I think this kind of quick overview of Sanctum prefaces a lot of deeper conversations we could be having in the future. And the final Balaji quote is, "We're about to enter an age of global monetary competition." And when we speak about unifying liquidity, like what Sanctum's approach seems to be, that kind of sets the stage for doing it, and where also businesses have to start thinking about their own monetary policy and kind of joining that competition. So it's really interesting.
Very fascinating. We'll have to probably devote an episode to that topic in the future.
Yeah, definitely. But this was a great overview of like the LST market and how it's set up on Solana right now, what the core differences are to Ethereum. I know you're a bit under the weather, but thank you for sticking with us. Your voice managed to get through this pretty well. This is a good overview of all this stuff, and we're going to definitely come back to this topic as things develop, because as the data shows, it's still really early on Solana. Somewhere around 6% is liquid staked, so I'm sure things are going to change quite a lot in the near future.
Yep, always happy to jump on with you, Oskari. Apologize, everybody, for my voice and the noodle brain to some extent as well. But we'll be back 100% next week.
Yes. Last week it was audio. This time it was a voice. Next time it's better every week. Thanks.
Exactly. Growth mindset. That's it. All right, we'll see everybody next week.